Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Okay, so today let's talk about regional areas versus CBD type locations for investing. It's pretty self-explanatory. I mean, regional, for most people, think country towns, but I'm going to actually change that up a little bit and say, well, we've had a significant change or shift in thinking since the COVID pandemic broke out that, you know, regional areas are quite often coastal areas as well. And I think Australians over the pandemic felt like they may not have gone to a country town, but they were certainly prepared to move to more regional coastal towns with accessibility to the major cities. Yeah. But certainly it drove some people out of the cities because people had health concerns, but also felt a little bit more freedom with regional coastal locations in terms of not as strict lockdowns and you know, if you're allowed to exercise once a day, it's probably not a bad thing to walk along a beach as opposed to stroll around a small park near your home.
Well, yeah, so, my take on it was that the people just saw that they had the opportunity to, which never could before with, you know, they were forced to work from home and their employer was forced for them to work from home and like, well, why can't I do it from wherever I really want to rather than in Melbourne, in soggy Melbourne, you know, I'll move to the sunny coast for 6 to 12 months and do it there instead.
Yeah, absolutely. And you know, one thing that's interesting is there's still probably a lagging effect of people working from home. And I mean, it's shifted a lot of employers' thinking. I know, you know, particularly in the bigger cities like Sydney and Melbourne, I know there's some larger corporate organisations that are now pushing and really enforcing people to come back into the office because it's been a really interesting space. You've got all these large companies with all this CBD commercial space that only a quarter of their team are sitting in and they're paying huge rents and so forth. So they're really questioning the viability of even, you know, having that much space. So now they're trying to bring their workforces back in, which, you know, again, will be interesting to see if that pulls more people back to CBDs. But I still think there's been a large proportion of people that have remained in those coastal regional areas that have seen, you know, significant growth over the last 5 years, almost to the point where in some locations they've outpaced CBDs, but certainly kept up or close to the same level that CBD locations have. Which I've never really seen before in 20-odd years. So it's interesting space.
Yeah, I mean, I think we mentioned it in the last couple of podcasts, but that my take on is the change in priorities. You know, so people did move away or tried it, the full work from home because they had to sort of thing, and now are shifting to that more hybrid model. So they've got to be within some proximity to, you know, their workplace, you know, but it's only going in 1, 2, 3 times a week. So which they'll can jump on the train and be happy to then, you know, commute a bit further because they're not doing it every day, I suppose is what I'm trying to say, which is then extending out to those regional areas is sort of my sort of, you know, way of sort of understanding it.
Yeah, and look, I think off the back of the pandemic also it's actually accelerated some people's thinking. I mean, I know talking to a lot of people in Sydney and understanding some of the shift that's gone on where, you know, with what we went through with COVID has made people to your point, made people revisit their priorities and their goals. And, you know, take in case somebody that owns a home in Sydney that might be worth potentially $3 million.
Yeah.
have sold up, got $3 million to play with, they can go and move to, a mid-coast regional area in New South Wales, and they can get a really nice home for $1.5 to $2 million.
Yeah.
A really nice home. Yeah. And basically they've got $1 million left in the bank or to invest to create a passive income. So they live a comfortable retirement. So, and those people are making
not need to go back to that same job as well. Because they don't have those commitments. They can go part-time or whatever sort of thing, or change careers totally, to something that they've always wanted to do or something.
Absolutely. And they might have probably, if the pandemic hadn't happened, they might have done it 5 years later than what they have, but they've just brought it forward because, again, with the pandemic, we saw a significant upswing in property values, particularly on the East Coast at the time. We saw 20+% jump in the first 18 months of COVID, and that was probably the impetus for some people to make that shift. So, look, historically, regional properties, regional dwellings have always performed at a slower pace than capital cities, because when you look at the fundamentals of capital growth, it's really driven by things like jobs and infrastructure and the population shift. People are gravitating towards, again, those jobs, infrastructure. Supply and demand is a big one. Like I've touched on before, and you and I have spoken about a bit, land is scarce. So therefore, unless we're building more units, then we're in an undersupply of dwellings in larger cities around Australia at the moment. Not all, but most of them. So when supply and demand is out of kilter, then obviously that's going to drive up growth as well. So, that's always historically been, some of the key fundamentals for capital cities growing. But, now because of this shift in mindset, it's brought some regional, not all, but some regional locations, much more attractive than previously thought. So,
yeah.
With regional areas, obviously the benefits that come from those are affordability, lifestyle. It's obviously a different pace, bit more greenery rather than being in the concrete jungle of a CBD. With those regional areas, I think people, tend to just relax a little bit more. And again, it's not everywhere, but I think Australians typically, you look at our 95% of our population live either on the coastline or close to a CBD. We've got this big desert in the middle of our country that obviously wipes a lot of that opportunity away. But it's about as an investor, it's about playing it smartly and with a strategy. And I always think it's better to be a little bit cautious and make sure you've got a clear exit strategy with your investments. You don't want to be in a one-horse mining town that's going to have volatility, or, you're not knowing who you're going to be able to sell that property to in 20, 30 years' time when you finish investing in there. So, there's always going to be that demand for, good suburban, close to CBD type properties, but also, good, strong, fundamental regional areas as well. So it's interesting. That gap has definitely sort of narrowed, and particularly like we've sort of talked about on a previous episode, not everyone wants to live in a unit. So if you can still have a bit of land and be close to the coastline in those regional areas, still have accessibility to the CBD, obviously a popular one in New South Wales, for example, is the Central Coast. Is not considered that far from Sydney CBD. So that's been a strong success story over the years.
Yeah. And I suppose it comes back to that when you're talking about the supply and demand. There's been this massive increase in lifestyle change on the demand side, on the supply side, especially in these regional places, in terms of like planning, for future, to utilities like roads and infrastructure that goes in, it just never caught pace. So you had this massive difference, which forced prices through the roof. Short term, I'd say. I don't think that's going to happen all the time, because that lifestyle influx of people all wanting the same, then that their feasibility, I suppose, is what I'm saying, at those prices sort of dwindles out a bit. Which we saw, I think. I'm trying to think of the Sunshine Coast. Pridgeon Springs. Springs to mind. Like where that sort of occurred. It's only a small pool, but the prices went ballistic there.
Yeah, absolutely. And Sunshine Coast is a really good example. I mean, call it 7-8 years ago, you could comfortably get land in a lot of locations on the Sunshine Coast, but there's been a lot of migration to attractive areas like the Sunshine Coast for all the reasons that we've been talking about.
Yeah.
So there's now there's as much scarcity in land on the Sunshine Coast as there is in a market like Brisbane.
Yeah, amazing.
So again, that's going to continue to drive prices, because human nature is when something's hard to get and it's a finite supply, we just tend to want it more. There's a bit of that FOMO effect, and so it goes through cycles, and you have people that push up the prices because they just want to get into the market and there's not many opportunity around. So, it's interesting. But one good point you made earlier, and one thing I want to touch on with the whole regional versus capital cities, conversation is, we've talked a bit about the COVID pandemic and what's transpired over the last 5 years, but we've just got to be careful as investors that we don't make all of our decisions based on what was today's and yesterday's new thing. I like to look at longer periods of cycles, ideally sort of in and around 10 to 12 years.
Yeah.
Because, things can change, particularly over the course of a full cycle. So we may potentially see a vacuum effect to a degree, of people driving back into the CBD type locations, which then potentially expose a little bit of an oversupply, or certainly potentially even a reduction in rental yields in those regional locations as there becomes more choice for tenants or buyers. So before you race out and go and buy a regional property in some of the locations we've discussed, again, it's about having the right strategy, understanding the right fundamentals and what's driving that, but also looking, the best way to look at property and how it's going to perform in the future is probably to look in the rear view mirror and use that as a guide over the last 10 to 12 years as to what's happened. It doesn't mean that necessarily means that's going to happen moving forward, because things change, like a COVID, or like for Brisbane, like the Olympics, or dare I say it, for some locations, and we're affected by GFC. Yeah. So we always have these one-off events that come up that can throw a little bit of a kink in the data, but generally speaking, as a guide, it's worthwhile looking at. I always like to do the research and the analysis to formulate the right opinion. So
yeah, and that's something I was going to say. Is like you sort of answered. I was going to say, is this a paradigm shift in the views of where to invest, or it just comes back to the fundamentals are still the same as what they were before these events? Because in history, there's always going to be some event anyway, and when you look back, it's already those events already contained in those results anyway. So
yeah, absolutely. And again, I think there's no one size fits all here. I think it's got to be, I always talk to investors on a one-on-one level, because what's right for me is not what's right for you, and potentially not what's right for the next person. It all comes back to what are your goals? What are you trying to achieve? What's the right strategy we apply to that? Because, potentially, a regional location might be more attractive to some, but it might be a longer term play, whereas some others have got a strategy where they need to see some significant growth in a shorter space of time. That may not be the right call for them. So we really try and tailor it to the individual. One thing I was going to ask about, Simon, I know, from time to time over the years, we've seen some lenders put a bit of a postcode restriction on some areas. And I've seen that happen more so in regional areas or outer lying areas than, CBD type locations. And when I say CBD, I'm not talking purely the city. I'm talking generally, give or take 30 to 40 kilometres of a radius of a CBD. What are your thoughts on why lenders do that and how long that lasts?
Yeah, well, it comes back to what you said originally, and the restrictions really come out with, let's categorise those properties a little bit further as well, where you've got those remote style properties. And most of those restrictions came about, like you mentioned, there was a bit of a risk. Let's say the mining towns was a classic example, where you had rental yields were just through the roof. But the reason is because there was no other housing availability for the workers in that mine. And the mines just needed the workers there, happy to pay the high rents just to make sure that they're available, because when they factored in, even those high rents and expenses in their income statements, it was still getting a massive return from the mine. So it was just the cost of doing business, essentially. From the lender's point of view, they could probably see that this was a short term, and a very high risk that if something was to happen to that mine, we've seen a couple of them where commodity prices change, and then essentially then the mine numbers don't stack up anymore, and so they have to mothball it and close it down. And then what happens to the rents and down the track, then the property price is it just falls through the roof, because no one wants to pay high price for a property in a mining town. The reason why it was high price, it came down to the rental yield that it was presenting, which was 10-15%, and that's why. And so to answer your question, it just came down to the risk from the lenders. Didn't want to be have a property underwater where the loan amount was higher than its the property's value, and then they had to try and sell that property because the rental income wasn't coming in, and they're stuck with this property, that's underwater.
Yeah, right. Interesting. When we're talking regional areas, mining towns are a whole nother topic of conversation. It's not one, and I don't mind being honest with everyone and saying this, it's not one that I'm too comfortable with. I just feel the fundamentals are a little bit risky.
Yeah, and I should clarify as well. When I use that as an example because it's got those great extremes in there, which people can sort of understand. But when you're talking about like regional areas like Sunshine Coast, Geelong, Newcastle, things like that nature, the lenders don't have any problems with those particular types of areas. That it's a long-term established market. They're really looking at those, one-horse towns or the mining town, which is artificially, increase the prices too much sort of thing because of a short-term need.
Yeah, of course. So with investors, we obviously, once we invest in a property and we've seen some growth out of that property, we really want to try and get into another property to create further wealth. And, what I've always said to people over time is, there's as much strategy in your lending as there is in the property itself and the selection of the properties. So how does a person really move from one property into their second or their third property in relation to debt recycling?
Yeah, so debt recycling is an interesting topic. You'll see it sort of come up, and broadly speaking, it doesn't directly apply to just houses and purchasing property as well, which is good. So the concept's built about, and we sort of go, I'll take a step back. It's to do with that a loan's tax deductibility is to do with what its purpose is, not what it's secured against. So if I can use an extreme example, going back to those one-horse mining towns, if you remember back in the day, they were like, $30,000, $40,000 or something. If you were to purchase those with, say, like a personal loan, and that's all the personal loan was used for, buy that house for $30,000, $40,000, then the interest is from that loan is tax deductible because the purpose of that loan was to buy that investment property. And so like when we're thinking about, pulling equity out of, let's say, an owner-occupier to purchase or have a deposit for an investment property, then that's tax deductible. The purpose is tax deductible. So it's really important to sort of remember that. It's not to do with, what the loan's secured against if it's tax deductible. And inversely, you hear some people incorrectly think that way, that they've got an investment property and let's say they've got their owner-occupied mortgage and it's got $200,000 left to go sort of thing. Yet their investment property has grown quite considerably. And what you'll hear them say is, well, what I'm going to do is increase my investment property loan $200,000 and pay off the home loan, and then that way it's tax deductible on the investment property. But again, applying those principles, that purpose of that loan is to still pay off an owner-occupier. So you can't sort of claim interest on that, So you've got to sort of keep that in mind when you're looking at doing that. So as long as you follow that sort of that pathway. Anytime you pull out money from your home loan, so if you've grown some equity in your home and you pull it out and you purchase another property, that's tax deductible. When you do that, you've got to make sure that you've got a loan split in there. So if you've made some extra repayments or you're getting a new loan, you just got to make sure that when you're setting that up, that it has got that split in there. That way, come tax time, you can clearly see the interest which was calculated and expensed on to do with that loan, and then you can put that into your return sort of thing. If you don't have the split, you've actually manually got to calculate it out. The ATO has got a great website with an example of how you do that, and it's quite complicated, and your accountant's going to hate you if you don't have that split in there, because it just becomes another minefield. The other negative point with not having a loan split that issues separate statements is that you can't then focus on paying the non-deductible debt, because if it's all in one pool and doesn't have that split, then the interest a portion that can be claimable actually gets paid off at the same rate as the non-deductible one as well, sort of thing. So whereas if you've got a loan split, you can clearly put all your extra repayments onto that non-deductible debt and clear that first, and then you can reassess what your priorities are and if you're going to start to knock down that interest tax deductible debt. And likewise, I was saying, if you're going to use it for maybe not a property purchase, but maybe in shares or an ETF or even a business, same principles apply. If you've made those extra repayments and you've got some redraw there, set up a split, purchase those shares, investments, whatever, you can then get the return from those investments to then knock down, so let's say your dividends, to knock down that non-deductible debt as well, to assist in doing that faster. You grow that extra, that redraw in your loan account again, and you just do it again, hence the term recycling, eventually till your non-deductible debt's gone. The other point I was just going to raise as well is it's different to an offset account. So don't sort of get confused that I'm going to pull money out of my offset account and do this. The offset account and redraw are two different things. So hence the term debt recycling. You've got to repurpose the loan. So you've got to bring it right down to zero. And just a side point, when I say zero, just be mindful that some lenders, if you do pay your loan down to zero with the thought to then draw it back out the next day, that some of them will actually close it automatically, as well. So always leave maybe a small balance owing, like $100 or something, once you pay it down to then redraw it back up. So once you've done that, also make sure you keep a record of that being done as well. So yeah.
All very interesting, and it's they're very strategic. Developments in moving forward. It's probably timely to remind people it's always wise to seek advice based on your circumstances and not just simply go out and act on what Simon's just said, because it may not be appropriate for you. We'd rather talk to you and make sure that it is appropriate for you. But really interesting stuff. And Simon, just quickly, obviously the old adage, let's take the average couple, for example, that have got their own home and they've got still got some debt on their own home, which we classify as bad debt because it's not tax effective debt. And because they're solely responsible, not rental income, but they're solely responsible for making the repayments. Versus investment debt, which is good debt because you've got tenants and the rental income's contributing to paying off the mortgage and the tax benefits. So strategically, I would say most people would be best with any additional payments paying down the bad debt portion, to your point. And really with what you're saying around, having the split and releasing the deposit from that out of your own home on that split, your investment then becomes virtually 100% tax effective debt, doesn't it? So.
Oh yeah. So so if you let easy numbers, you need the 25% deposit out, then that portion is tax deductible, and then the 80% loan that you've also got out there is also tax deductible. So you're making sure that could be with a separate bank to try and avoid cross securitization. So you've got those, as I said, record keeping, those two statements, one for the main loan and then the other, the smaller deposit portion, making sure you give those to the accountant or apportion that in your spreadsheet for the end of the year, and to keep that on file.
And just if anyone picked up on that, if anyone's got any concerns about Simon's maths, 80 plus 25 is not equal to 100. But it's obviously 80% loan, 20% deposit, and the extra 5% is basically what Simon's allowing for things like costs, things like stamp duty and legal fees. So it's that's just rough rule of thumb of how we work those numbers. So
yeah, definitely. I mean, the debt recycling thing's been very popular with, of late been, not of late, but previously years where the share market's gone gangbusters, and because it's maybe an easier way to keep up with, the extra repayments, to then quickly allocate them at the end of the month to do this process sort of thing. Now, if once the year's at the end and they've built up a good nest egg and then they want to move that into property, then you can sort of redo it again and repurpose that loan again, sell the shares and the ETFs, pay down the loan or nearly pay it off, and then pull those funds back out then for the investment deposit. And then that resets that loan again. It recycles the purpose of the loan, keep those statements, and then that's tax deductible again, sort of thing.
I think, Simon, it's probably safe to say that for some people it would help on a visual. That's not so easy on a podcast.
No.
I'm sure you've got a recording on the website somewhere where we can run through that visually.
Yeah. 100%.
Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode.